Inflation doesn't usually return with one big headline. It comes back through pressure points, small areas of the economy that stay hot even when everything else cools. That's why inflation is so difficult to finish. Central banks can slow demand, rates can tighten credit, growth can slow, but inflation can still reaccelerate if a few key inputs stay elevated or spike again. So the right question isn't, is inflation over? The right question is, where is the pressure still building? Because inflation doesn't need to be everywhere. It only needs to be strong in a few places to keep the overall number sticky. Today, there are 3 pressure points that matter most: services, energy and transport, and wages, especially where labor is scarce. If those 3 areas stay hot at the same time, inflation can come back even in a slower economy. Let's start with the first pressure point: services. Goods inflation can cool quickly. If demand drops, retailers discount. Inventories clear. Prices adjust. Services don't work like that. Services are tied to labor, schedules, and local capacity. And in many economies, services make up the largest share of consumer spending. That's why service inflation is the hardest to kill. Think of rents, insurance, healthcare, education, repairs, personal services, subscriptions, and anything where the price is set by staffing and capacity. If service providers can't hire easily, they raise prices. If insurance costs rise, premiums rise. If housing costs remain high, rent stays sticky. Say once service prices rise, they rarely fall quickly. They tend to level off, but at a higher baseline. This is why inflation sticks even when goods prices look calm. The second pressure point is energy and transport. Energy is a classic inflation trigger because it hits everything. Fuel costs change distribution costs. Transport costs change retail costs. Electricity costs affect industry. And energy price moves can hit consumer psychology fast. Even if energy prices don't stay elevated forever, spikes matter. Spikes reset expectations. They push businesses to raise prices just in case. They push households to cut spending elsewhere. And they can spread into services through higher operating costs. The key is not whether oil is high today. It's whether the energy complex becomes volatile again. Volatility creates pricing behavior. And pricing behavior creates inflation persistence. Transport works the same way. When shipping and logistics costs jump, businesses adjust pricing to protect margins. Even if the underlying demand is weak, businesses don't like reducing prices after they've moved up. They'd rather shrink volume than cut price. That's how inflation stays sticky, even in slowdowns. The third pressure point is wages. Wages don't always drive inflation by themselves, but wages shape whether inflation stays elevated. If wages keep rising in a tight labor market, service providers raise prices to maintain margins. If wage growth slows, service inflation usually cools with a lag. So wage momentum is the key. Not just our wages rising, but our wage pressures easing across the economy. Now here's the part people miss. You can have slow growth and persistent inflation at the same time. Because inflation is not only about demand, it's about constraints. When the economy hits constraints, labor shortages, capacity limits, energy volatility, prices can rise even if growth is mediocre. That's why inflation is the most political economic variable. People feel it daily. And it's why policymakers watch it closely. So how do you tell if inflation is coming back? You don't need a crystal ball. You watch 3 signals. First, services inflation trend. Is it cooling steadily or just flattening at an elevated level? Second, energy volatility. Are energy prices stable, or are they swinging enough to influence business behavior? Third, wage momentum. Is wage growth easing, or does it remain hot in key sectors? If 2 out of 3 are rising, inflation risk increases. If all 3 rise together, inflation can reaccelerate quickly. Now, why does any of this matter for your life and for markets? Because inflation changes everything downstream. It shapes interest rates, it shapes mortgage costs, it shapes credit conditions, it shapes business investment, and it shapes consumer behavior. If inflation looks like it's returning, rate cuts get delayed. Borrowing costs stay high. Credit stays tighter. And risk assets can reprice, even if the economy is slowing. That's the uncomfortable scenario. Slower growth, sticky inflation. So what should you track in real time? Track what people pay every month: rent, insurance, utilities, food away from home, repairs, healthcare costs, and look at whether those costs are stabilizing or still climbing. Then watch energy and transport headlines, but focus on volatility. A one-day spike doesn't matter. A choppy month matters. because a choppy month changes how businesses price. And finally, watch the labor market through the lens of wage pressure, not just unemployment. Wage growth, job switching, and labor scarcity in services. Because services are where inflation sticks, and services are labor. So here's the bottom line. Inflation doesn't need to restart everywhere. It only needs pressure in the right places. Services, energy and transport, wages. If those remain tight, inflation stays sticky. If they reheat, inflation comes back. And when inflation comes back, the policy response follows.